All right, let's get right to it. For the last couple of years, AI has been all about the story. Well, story time is over. We are now officially in the results phase. In this explainer, I'm going to show you the hard data that proves AI's benefits are real and growing fast. We'll look at why the opportunity is spreading to unexpected places, like the energy sector. And maybe most importantly, we'll break down the 4 key reasons why this is absolutely not another 1999 tech bubble. Okay, so first things first, and this is the most critical point. We've crossed a major threshold. The era of just talking about AI's potential, that's done. We're now in the phase of quantifiable results, where companies can literally point to their bottom line and say, AI did that. And you know what happens when the results get real? The circle of winners gets bigger. The benefits aren't just for a handful of tech giants anymore. Nope, we're seeing AI create serious value across a whole range of industries, which, for savvy investors, opens up a ton of new opportunities. Now, let's just tackle the elephant in the room head on, shall we? The bubble fear. Is this just another dot-com boom and bust waiting to happen? Well, the short answer is a hard no. And the key difference is the financial health, the fundamentals of the companies leading the charge. Today's AI leaders are built on actual profits and cash flow, not just speculative hype. And we're going to break down the exact numbers in just a bit. Okay, so enough talk. Let's get to the proof. How do we actually track this shift from a nice story to real, hard results? Well, it all comes down to what the companies themselves are telling us. So, to get this data, analysts did a massive deep dive. I'm talking about combing through thousands and thousands of corporate earnings calls and industry conferences. From all that, they identified a specific group of companies they call AI adopters. And these aren't just companies using the buzzword. These are the ones actually putting the tech to work. And this chart, it tells the whole story. Just look at the trend here. Among those AI adopters, the percentage reporting actual measurable benefits is taking off. It shot up from just 15% last year to a projected 24% by the third quarter of this year. The proof isn't just showing up, it's accelerating. Now, what's really fascinating here is where these benefits are coming from right now. It's all happening internally. Companies are talking about cost savings and efficiency gains almost twice as much as they're talking about growing revenue. You know, this is the first wave. It's the low-hanging fruit, using AI to get leaner, smarter, and more productive. That top-line growth, that's the next chapter. So, if the benefits are real and they're growing, where should investors be looking? Which sectors are really cashing in on this? Okay, no big surprise here. The tech sector is leading the pack, with almost 40% of companies reporting quantifiable benefits. Right behind them, you've got communication services and financials. These are the established leaders, the ones weaving AI deep into the fabric of their operations. But listen up, because this is the slide that should get you excited about finding the next wave of growth. Take a look at the energy sector. A year ago, exactly 0 companies in that space were reporting measurable benefits from AI. This year, 10%. This is huge. It shows AI is breaking out of the tech silo and into the core industrial economy. It's creating value where most people just aren't looking yet. And even within the tech world, this isn't just surface-level stuff. It's incredibly deep. I mean, in software and services, a whopping 59% of companies are seeing real results. As one executive put it, AI is driving significant efficiency. We see this across the board. This isn't an experiment anymore. It's a core part of the operation. Okay, let's circle back to that 1999 comparison because I really want to dismantle this fear piece by piece with cold, hard data. The market conditions today are just fundamentally different. They're way, way healthier. Difference number 1, cash flow. This is huge. Today's top companies have a free cash flow yield, that's basically the pure cash profit they're spinning off, of about 3.5%. Back in the year 2000, it was a measly 1.2%. So today's leaders are cash-generating machines, not cash-burning furnaces. Big difference. Second, valuations. The top 10 stocks today are trading at about 31 times their forward earnings. In 1999, that number was 44. So today, you're paying a lower price for companies that are vastly more profitable, with operating margins more than 20 percentage points higher than their dot-com era counterparts. It's not even close. Third, the whole economic picture is just a world apart. Think of it this way. In 1999, the economy was overheated, and the Fed was slamming on the brakes, hiking interest rates like crazy. Today, we're in the early stages of a recovery, and the Fed's foot is hovering over the gas pedal, ready to start easing. The wind is at the market's back this time, not in its face. And finally, maybe the most important difference of all, just look at who's footing the bill for this revolution. Today's AI build-out is funded by the hyperscalers, Microsoft, Google, Amazon, companies with fortress balance sheets and stellar AAA or AA credit ratings. The dot-com boom was funded by telcos drowning in debt with junk-level ratings. The foundation today is rock solid. So, now that we've hopefully put those bubble fears to rest, what does this all mean for corporate profits, for the market, and, for your portfolio going forward? Well, the impact is going to be significant. Projections are showing that these AI efficiencies could boost the entire S&P 500's net profit margin by 30 basis points by 2026. Now, that might not sound like a lot, but for an index that massive, that is a huge injection of pure profit straight to the bottom line. And if you zoom all the way out, if you look at the total potential prize here, it's just staggering. Full AI adoption could add over $900 billion in annual net profit to the S&P 500. This isn't just about one sector. This is a fundamental driver of future earnings for the entire market. Okay, let's wrap this up with a clear game plan. What are the key takeaways? First, stop thinking of AI as some far-off story. The benefits are here, now, and they're measurable. Second, you have to look beyond the usual tech suspects. Leadership is broadening, and fast followers like the energy sector are where the next opportunities might be. Third, forget the 1999 comparisons. Today's market is fundamentally stronger. And that leads to the most crucial point. Focus on companies that can show you the numbers, the ones with a demonstrated, quantifiable return on their AI investment. So I'll just leave you with this one question to think about. As this revolution spreads from software to the industrial world, and as the focus shifts from just cutting costs to actually generating new revenue, are the biggest long-term winners going to be the obvious names we all know today, or are they going to be the fast followers of tomorrow?